the world is starting to realize that this trend is inescapable. We're in a debt trap right now, and the Fed is trapped. So the longer they keep rates at these levels, the worse it's going to get.
Two investment megatrends are developing right now. Number one, a debt trap, the likes of which has never before been seen. And number two, the rise in energy demand from the very quick scaling of AI data centers all around the world, which will need a lot more energy than some analysts are predicting we will be able to supply. Both of these trends have huge implications for our investments. Joining us to discuss this is Brien Lundin, editor of the Gold newsletter and producer of the New Orleans Investment Conference. Welcome to the show, Brien.
Great to be with you, David. Thank you so much for the opportunity to speak with you today.
Well, thank you for being on the show. I've heard about you for a while. I've just never had the chance to interview you. So pleasure to finally meet you and introduce you to my audience, the David Lynn Report. I want to start by talking about this article I read recently on Tech Radar, recapping a recent product release by NVIDIA. I'll just read you the first three paragraphs from this article. There was something that Jensen Huang, CEO of NVIDIA, said during the keynote that shocked me into a mild panic. NVIDIA's Blackwell cluster, which will come with 8 GPUs, pulls down 15 kilowatts of power. That's 15,000 watts of power divided by 8. That's 1,875 watts per GPU. The current gen Hopper data center chips draw up to 1,000 watts, so NVIDIA Blackwell is nearly doubling the power consumption of these chips. Data center energy usage is already out of control, but Blackwell is going to pour jet fuel on what is already an uncontrolled wildfire. Worse still, Huang said that in the future, he expects to see millions of these kinds of AI processors in use at data centers around the world. Here's the kicker, Brien. 1 million Blackwell GPUs would suck down an astonishing 1.875 gigawatts of power. For context, a typical nuclear power plant only produces 1 gigawatt of power. So what this author is saying is that projecting forward, the scaling of power consumption by data centers for the AI trend is going to really put us in a pickle when it comes to data, or not data, but power supply. What is your response to this?
Yeah, we really are living through an extraordinary time for investors when there are two macro, really secular bull markets that I think are going to progress forward in metals and mining, and they both have separate drivers, so fundamentally different from each other. This energy transition, this electrification, and we've always talked about the electrification of transportation and how that's going to put demands on base metals and copper in particular. But we also have this new world of energy production, the necessity of producing much more energy, and that's going to include all of the aforementioned metals and mining, but also uranium going forward, and probably natural gas as well. So, there's talk about in the future that these data centers will have these modular nuclear plants next to them, just supplying the data centers, and we're going to actually get to that point. Regardless, we will need much more uranium. That's a story that's been long in the making and is, I think, irreversible and irrefutable. And then on the other side of the market, we have this monetary, this macro argument for the monetary metals of gold and silver that I think is equally powerful. So if you're investing in metals and mining right now at these levels, knock on wood, I don't want to jinx it, but I don't see how you can go wrong over the years to come. These are mega trends that I believe are irreversible, and we're facing supply demand imbalances just on the base level of demand. So when you add all of this on top of it, it's going to be an extraordinary time, I believe.
Do you think nuclear is the proper solution to meeting our energy needs in the future?
Yeah, and obviously so. You need that base load energy production. I think that some of the renewables have promise in certain applications, but I think they've been widely and wildly overhyped. And nuclear provides what you need, and you see even the most avid green advocates starting to come around and recognize that nuclear is the solution, and really the only solution out there. So yeah, it is coming around. It has been designated as a green solution, a green source of energy, and it's only a matter of time now.
Well, the issue is it's going to take a while to build new reactors and get them online, right? And this energy demand is going to start scaling very quickly. So how do we meet that gap?
Well, the easy answer is that we're not going to, and the, you know, restraints and prices hopefully will rise so that it will stimulate new production. But in addition to the energy production, you also have a grid that's completely inadequate to supply that power where it's needed. And
Why
that's
is it,
where
sorry, why is it grid inadequate? Can we expand on that?
it just doesn't have the capacity for the energy demand. And, there's, for example, in California, you have restrictions on charging EVs because the grid can't supply the amount of power necessary. So we have to rebuild the energy grid in the US and really around the world. And that's going to place very severe restraints on copper supplies. That demand alone will far exceed the global copper supplies right now.
The AI hype, if you want to call it a hype, really started, I think, end of 2022, all throughout 2023. But uranium was pushing up in price as early as 2021. So you'll recall, as of August 2021, it was still trading around $30 a pound. It reached $107 just earlier this year, Brian. It came down. Now it's down to about 90, but that's still a 3x increase in price over the last 3 or 4 years. 3 years. What happened there?
Well, we had the nuclear power plants who have by the contracts to for nuclear supplies for uranium supplies started to feel the pinch. They didn't get into panic mode, but that long-awaited recontracting that we had been waiting for many years started to happen over the last year, and they never got again to a real emergency phase, but they began to feel some urgency into re-upping on their uranium supply contracts, and in fact had to go into the spot market for some of their supplies. We also had the brilliant move of the Sprott Physical Uranium Trust that came in and started taking uranium off of the market, and prices set at the margin. And while the SPUT didn't really make a huge impact on uranium supplies, it did on the margin, and that's all it took to take that fairly tight market and really affect supplies and affect the price.
This came in from earlier this year. Cameco looks to increase production as net earnings double. The Canadian company said it is strategically positioned to increase Tier 1 production and plans to begin work to extend the life of the Cigar Lake mine to 2036. Now, we do know that in North America, mining of uranium was limited due to relatively low prices in the past couple of years. Is that going to change right now?
Oh, absolutely. The cure for low prices are low prices, and the cure for high prices are high prices. That's the old adage in the commodity markets. High prices bring on new production, low prices collapse production. What we saw since the last uranium mania and around 2007 or so was that the 400 or so companies that sprouted like mushrooms after a rain back then slowly faded away. But that big burst of exploration saw those projects and those companies coalesce into what is today probably about 20 or so companies, of which maybe only half are really worth looking at. So all of that, those projects are now held in those relatively few companies. And over the succeeding years, the best of those companies advanced those projects to either into early stages of production or just on the cusp of production. So we're in a position now where the pathway, the timeline to production, to having uranium production respond to higher prices, is relatively short. That said, the anticipated production increases over the next few years are going to fall well short of the demand increases we're seeing. So I don't think it's going to be a detriment for the market, and we're still going to have a long period of higher prices going forward.
Are uranium producers in North America at least profitable at $89 a pound?
By and large, they are, and the general view for years was that it would take about $80 a pound to incentivize new production. And we're at those levels now, and we put in enough time above those levels that we're starting to see companies going into production now.
Well, if you take a look at the long-term uranium chart, the last time it was this high it was actually much higher, was in 2007 during the Fukushima crisis.
Yes.
It's since come down. It looks rather bubbly if you just take a historical technical chart perspective. Would you agree with the assessment that maybe it's going to it's going to really correct at this level?
I don't have the feeling that it will correct severely from this level. I think it's already come off the boil enough to get some of that speculative fervor out of the market. So I think we're at a good level right now at what I would think would be a longer term trading range or base. And, the longer term picture, I think, is one of a slower but steadier rise.
I want to get your thoughts on copper now. This came in from Pierre Andujon, who is a hedge fund manager, previously a Goldman Sachs trader. Now he's managing Blue Gold Capital. This is what he said about copper. He thinks that prices could reach $40,000 per ton in the next few years. For context, it's currently at around $10,000, $11,000 per pound. So that's a ton rather. So that's a 4x increase. He said, I think we should see prices up to $40,000 per ton over the next 4 years or so. I'm not saying it will stay there indefinitely. Eventually, we will get a supply response, but that supply response will take more than 5 years. And he told the Financial Times in this interview, we are moving towards a doubling of demand growth for copper due to the electrification of the world, including electric vehicles, solar panels, wind farms, as well as military usage and data centers, which we just talked about. Can you respond to this?
Yeah, I think that's a bit aggressive. My own view is that the copper price will reach about $8 or so over the next 3 to 5 years, and I think that's reasonable. I don't dismiss that prices in the range he's talking about, say, $40,000 or something on the order of 18.
Well,
to
he's saying $18 a pound, so that's
Yeah, 18
yeah.
to $20 a pound is at the high end of the most bullish forecasts that I've seen. And I don't think that they are not, I wouldn't dismiss that, but I think those are longer term, maybe 10 years down the road. The fact of the matter is there's probably 40 or so half a billion ton copper projects out there right now that are known, half a billion ton or higher or greater, that have yet to be developed because usually they weren't economic at the current copper prices or long-term copper prices, but also for geopolitical reasons and other factors. And if you look at the long-term trend of copper demand and copper prices, you realize it's not a question of how many of those projects will be developed, but that to satisfy the market demand, all of those projects would have to be developed. And those are the known projects. Those would take anywhere from 5 to 8 years to go into development. If they were started, it was the trigger was pulled right now. For new discoveries, you're talking 10 to 12 years from discovery to actual production. So it's not going to get any easier for copper supplies, and those that copper supply demand dynamic is only going to get tighter and tighter, more tightly wound going forward. So you could have a price spike at some point, especially if you see some of these situations on the futures exchanges where the shorts get trapped. But I think $18 to $20 is a bit further down the line. I think we're probably going to get $8 copper within the next 3 to 4 years.
Well, I've heard the argument that because permitting of mines is usually it takes longer in North America than, let's say, in developing countries like Latin America, for example, or West Africa. So that may I'm asking you, would that incentivize explorers to move to third world jurisdictions to speed up the process?
Well, they're going to move wherever they find the deposit. So you can't move the deposits to wherever they're found is where they will or will not be developed. I would push back on the concept that it's harder or it's easier in some of these third world countries, emerging markets to permit a mine. In some cases, you have political situations there that prevent development. Panama is a prime example of a major producing mine that was shut down for political reasons. It's tough the world over. And one of the things you see is that prices rise, then you have increasing incentive for governments to renegotiate their deals. It's not an easy business to supply these kinds of projects or these commodities to the market. So we're going to see those kinds of situations develop. And the world over, it's getting harder and harder to permit mines.
As an investor, do you have a preferred jurisdiction for base metals production and or exploration?
Well, I think rule of law, again, you're talking US and Canada as the best venues, and you can then divide it up between state by state and province by province. But generally speaking, the US and Canada are the best jurisdictions. That said, it's hard to find, if not impossible to find, any jurisdiction in the world today where there aren't problems and concerns and risks. And they tend to bubble up here and there all the time.
You've been involved in the mining space for a very long time. You're an expert. So I'd like to ask you about the mining sector at large right now before we move on to gold. As you know, both the large cap stocks and the junior stocks have been underperforming the underlying metals, copper and gold, for the last, well, mostly just gold for the last couple of years. First of all, I'd like to get your take on this and whether or not this is going to reverse. And number two, is this because of misallocation of capital from the miners?
To some degree, but really it's the market. I think you can get granular and myopic and look at the miners and especially the big producers and see how they've misallocated shareholder capital. But that's a side story in my belief, and none of these companies are growth stocks. When you look at Barrick or Newmont and you see that they're trading at the same share price that they were 20 years ago, you realize that these are cyclical investments. They're ways to leverage an underlying trend in the metals. And that's the big story. And since this rally, this new bull market in gold and silver, for example, started in the waning days of February, the general consensus view has been that the mining stocks have underperformed the metals. But since in that period, they've actually outperformed the metals. Granted, though, they have not outperformed to the extent that investors would have expected or hoped. So from that standpoint, at least the perception, they've underperformed. And I think that's due to two reasons. One, this rally, especially the first 6 weeks of the rally through mid-April, was just unrelenting. It's day after day of gains, almost uninterrupted, new records after new records. And investors were kind of shocked by that kind of a rally and were waiting for a pullback to get involved. And we did see that the miners have responded generally on the two corrections that we've had since this bull market began. And the other factor is that this rally has been somewhat mysterious, that the market doesn't really understand. Investors don't really understand the why behind this rally in the metals. If the Fed had pivoted and started to cut rates, then that would be understandable, and they could look forward and say, well, we're going to have 12 to 24 months of rate cuts. So this is a macro factor that is going to keep the metals market alive. So it's time to get involved and start buying the mining stocks. For much of this rally, we really didn't understand who was buying. And I think to some degree at least, we still don't have a full picture of who's buying, although we can credit it to kind of an amorphous group of central banks that are buying, particularly the People's Bank of China, and we can kind of credit it to domestic Chinese buying, and to some degree on the domestic Chinese future exchanges. It still feels like there's more out there. behind this rally, and we don't really understand where it's coming from. And if you don't understand the why behind the market, you don't have a good feeling for how long it's going to last. So I think that's made equity investors in the sector a bit hesitant.
So yes, it's true that the mining stocks have outperformed gold in the last couple of months, just because they've had this leverage to the rally. But investors are wondering now, Brien, if you take a longer term perspective, the GDX has not retraced its all-time highs back in 2011. In fact, far from it, while the gold price has and beaten its all-time highs. It's now at record highs. And so given this perspective, is there still value in investing long-term in mining stocks?
Well, I think that's a reason why there is value. If you look at a lot of these companies out there that have large resources, from exploration to development, but not actually in production, you can look at those resources and realize that they're trading at maybe a quarter of their all-time high. So in a normal market, much less a rollicking bull market, those kinds of junior companies should be trading at 4 to 5 times their current levels. So that's drill hole play type of returns that you can get in companies that are somewhat backstopped by the fact that they've already found something. So yeah, I think the long-term picture is very bright for metals and mining. It's the short-term picture that's a bit obscured and foggy. You don't really know where the metals are going to be trading a week or two down the road, but a year or two down the road, and you feel a lot more confident that they're going to be trading much higher.
Okay, let's talk about gold now then. Good segue. You wrote on your website, thegoldnewsletter.com, or just goldnewsletter.com, the massive stimulus plans, ever easier monetary policies, bailouts, and other government spending that have been showered onto global economies have created tens of trillions of dollars worth of new currencies and unsustainable levels of debt. We have never witnessed anything like this before. Over the long term, every currency will be debased. Every economy will suffer from dramatic levels of inflation. Walk us through your logic here and elaborate more, please.
Yeah, if you go back to when Paul Volcker, its Federal Reserve Chairman, killed off inflation, and he took the Fed funds rate well over 20% to do that. When he started cutting after he killed off inflation, if you go back over that 4 decade plus history and you look at the bottoms of each rate cutting cycle, you can see that the bottoms form a stair step all the way down to zero over those 4 decades. And that whenever the Fed tried to bring rates up to normalize them after a crisis has passed, it never got past the midpoint of the previous range before it was forced again to cut rates in response to a recession or some type of crisis. And so that is a trend of not easy money, but ever easier money. And it's a trend that over time has also encouraged the accumulation of debt. So one of the charts I use in my presentations shows the Fed funds rate over that 40 plus years going steadily lower. And over the same time frame, the federal debt going steadily higher and higher. And it's to the point now where we just simply can't afford the cost of servicing the debts at anything but interest rates that are below the rate of inflation. In other words, we have to have a monetary regime of negative real rates going forward, or the whole house of cards collapses. So if you have negative real rates, that is an extremely bullish environment for the monetary metals, gold and silver, but commodities in general and things in general, tangible assets.
Here's a few counter arguments to what you just said. So yes, negative real rates, generally speaking, are positive for metals, especially gold, but we're at negative real rates now. Gold has already seen its run. In other words, what you're talking about is already priced in. Can you respond to that?
Yeah, we're actually at positive real rates right now, depending on what rate of inflation you use.
Yeah, I guess depending on the measurement, yeah.
Because
It
yeah,
has been trending up, you're right.
yeah, and I think part of that is you look at the world in general, and the U.S. is just a microcosm, just a small part of that. And you have debt loads that have been created over these 4 decades that are so large, you have the potential and really the likelihood of a reorganization of the monetary system to some degree because of that, what I just said. Interest or debt loads too high to be managed at current interest rates. I think you have a general buying of gold and silver, the monetary metals, around the world. Central banks see what is happening. They're trying to gain independence from the dollar to some degree, but they also see what is happening around the world and see that there's some type of a reorganization that it will be necessary to reestablish credibility in fiat currencies. The currencies will have to be devalued against those debts because the debts are not decreasing; they're actually growing. So it's come to the end game of that long process, and whether that end game happens through this next boom bust cycle or this next crisis or the one after that or the one after that,
Yeah.
I don't believe anybody can tell, but we do have a feeling of confidence that we're going to want to own gold going into that.
Okay, so a few points as well. So first of all, yes, you're right. The CBO, Congressional Budget Office is projecting the deficit and the debt levels to continue to widen. As you've mentioned to me offline, interest payments on federal debt alone right now is $1 trillion. I believe that's roughly equal to, if not more, the military spending in the U.S.
Yeah.
Yeah, but here's my argument here. The economy hasn't imploded yet, so we can sustain this level of debt and interest payments. Do you agree or disagree?
No, I would disagree because we're running on the order of $2 trillion deficits
Hmm.
uh, right now. Before you add in the cost of servicing that, another $1 trillion, and you have debt, Treasury securities resetting at a tremendous pace. And if the Fed say cut at 6 quarter point rate cuts, if they started cutting today by 1.5% over the next 18 months, you would still have debt resetting at much higher levels, and you would still have, for instance, that $1 trillion debt service payments would rise to $1.2 trillion by next year. If they don't do anything and they leave the debt at where it is now, it'll rise to about $1.6 trillion next year. So it is the standard definition of a debt spiral. And even the issuer of the global reserve currency, at some point, numbers matter. And I think the world is starting to realize that this trend is inescapable. We're in a debt trap right now, and the Fed is trapped. So the longer they keep rates at these levels, the worse it's going to get. The longer they stay their hand in rate cuts, the more aggressively they're going to have to cut when they do cut. And I think that's just a reality right now that the numbers tell you if you look at it. And even if you look at the mainstream financial media, you see some of the more respected voices out there and now saying that, yeah, this trend is reaching its end. We are in the end game now, and something's going to break, and something has to change very soon.
Do you think the Fed is ready to cut anytime soon?
I think they're looking for an excuse. When you have inflations at stubbornly remaining elevated, they don't want to lose their credibility in the markets by cutting now, but they're looking for their first opportunity. That said, I think the end of the year for the first rate cut, or even going into next year, which the market is now pricing in, is probably about as accurate as you can get right now. And that's one of the reasons why we're seeing this, I believe, temporary weakness in metals prices.
So if you look at what the Fed has done in previous rate cut cycles, in 2006, it was at 5.26%, five and a quarter. And then they cut that down all the way to zero following the financial crisis. So historically, during recessions, they've had a history of cutting rates by the order of roughly 500 basis points. Now, in 2019, they cut it down from 2.25 or 2.5 down to zero, but that wasn't a financial crisis. So, what do you think may happen this time?
It will be extraordinary. It will make your head spin what they do this time. Because again, if you look at that long history, they had to keep lowering interest rates. Then with the 2008 great financial crisis, they went to zero, and that wasn't enough. They had to come up with quantitative easing and a number of other programs to rescue Wall Street. With COVID, they did everything that they did in 2008 over 4 to 5 years, and they did it in 4 to 5 days and to a multiple in terms of degree. They went right back to zero. They quickly doubled the Fed's balance sheet. And they came up with not just quantitative easing, but they actually injected money into people's bank accounts. They didn't even need the helicopters for helicopter money. They just sent money out to voters. So the next time, and the lesson from all of this is that the markets and the economy have become addicted to this ever easier money. And with each dosage of the drug, because the markets have developed a tolerance, the same dose gets a less of an effect. So the next time they have to do something, they have to increase the dosage substantially to get the same kind of an effect in the markets. So if you thought that COVID was extraordinary, what they do this next time is going to be really dramatic and something I think we can only imagine right now.
Let's do some imagining now. Can we see? Is it possible to see a repeat of 2008, which they cut it down back to zero?
Yeah, oh, absolutely. They'll go right back to zero if another crisis develops, and they'll find some excuse to do it. You remember Powell, even during COVID, when asked about the effects of this policy on the federal debt, said that the federal debt is unsustainable, but now is not the time to address it. And he continues to say to this day that it's unsustainable, but now is not the time to address it. They will always come up with some excuse to re-liquefy the markets, to provide financial accommodation, because the one thing that they want to avoid is a deflationary collapse. Central bankers know to avoid that, and they will open up the monetary floodgates to whatever extent's necessary to prevent that from happening. So yeah, they're going to go right back to zero. They're going to go right back to quantitative easing. There will be some fiscal rescue efforts, actually sending money to the people, directly depositing that money, and something else. We have no idea what that will be, but they'll dream something else up. And the corrosive effect of these cycles is that the currency loses credibility with the public. They begin to realize that these crises are coming at fairly regular frequencies, and with each crisis, their money, their currency gets cheaper. So that credibility will eventually be destroyed in the currency, and they'll have to reestablish credibility somehow. History shows that would happen with some reattachment to gold.
If rates fall down by the order of magnitude that we're discussing, can we expect inflation to reignite?
I think it already has proven that it's been reignited for a number of reasons. Services inflation was never zero, and it's always stubbornly around 2.5% to 3% or thereabouts. And we did have some supply constraints that brought goods prices higher. This depreciation in the purchasing power of the currency, I think that's going to be the big driver of inflation going forward, because again, we're in the end game of this very long-term cycle, and it is a debt trap that demands the depreciation of the underlying currencies.
In this, I guess, reset of the financial system, if you want to call it that,
Yeah.
which assets will likely do well? I mean, we're talking about inflation of all assets, right? Presumably, I could hold real estate and protect my wealth. Presumably, I could hold the S&P 500 and do, why gold in particular is my question.
Well, you have 4,000 or 5,000 years of history of gold as money, and as the foundation of every financial system, long-lasting financial system in human history. So, we have the longest track record you can imagine of human nature, being that organized governments, always overspend their means at some point. And every currency that has ever been established eventually went to zero. But gold has never gone to zero. It has been the one asset that's protected against this characteristic, this human trait of eventually destroying their currencies.
What is a reasonable gold price that you think would fit your thesis for what's about to come, this realization of this debt trap?
If you look at the fact that there's only been 3 gold bull markets ever in human history, in other words, where gold was an investable asset and not the money on which everything else is based. There's been 3 gold bull markets since 1971, when gold was the last tie between gold and the dollar was severed. You had the early 70s, the late 70s, and the 2000s. During those 3 periods, the price of gold went up anywhere from 6 to 8 times in value from its lows. The lows in this cycle was, the way I mark it, $1,040 in 2015. So if you figure that gold's going to go 6 to 8 times higher in this bull market, then you have a gold price at, say, $6,000 to $8,000 when all is said and done. I think the real question is not whether that is achievable. I think it's very much easily achievable. It's a matter of what is the time frame, whether that's going to be over 2 years to 10 years from now. I would say it's probably in the 5 to 6 year time frame.
Yeah, gold has had a history of 10xing, if you recall that, up until the all the way leading up to 2011. There was a 10-year bull rally starting from $200 an ounce, peaking at nearly $2,000 an ounce, right? So, I'm curious as to why you're being actually conservative relative to what it's done in the past.
Because when you start talking about $6,000 to $8,000 or $8,000 to $9,000 gold price, it's okay to say $6,000 to $8,000 to sound a little bit more conservative and
Sure.
gain a little credibility. But yeah, anything's possible. The low was actually in 2000 at $252 an ounce, and we reached 1960 by 2011. So that was about an 8 or 9 time increase. Yeah, I think that's the kind of thing that could happen. Now, if you take those 2 bull markets in the 1970s and combine them, then you get some ridiculous numbers, and then you're talking about a $20,000 gold price at the end of it all.
What was the main reason, in your opinion, for why gold stagnated between 2012 and 2019?
It was a period, if you remember, the actual peak in the gold price was 2011, and you can look back to the establishment of the of QE infinity, the announcement of QE infinity as virtually marking the high for gold. And you would have thought that was the most bullish possible event that you can imagine. The Fed came out and said, we are going to do quantitative easing. We're not going to call it QE1, 2, or 3 over a set period or a set degree. We are going to do QE for as long as it takes to get the effect we want. And that announcement, which on its face would seem to be bullish for gold, actually marked the top. And if you pull back, you can see that from that standpoint, the next announcement from the Fed was going to be the end of QE. It wasn't going to be another round. It was going to be, now we're ending QE. So the speculators who had been betting on these successive rounds of quantitative easing by the Fed then recognized that the game was up. It was a fait accompli. What they were betting on had actually occurred. So they began to pull from the market. That started a downslide in the gold price. And as we saw, the next big announcement was that they were withdrawing back from quantitative easing and starting to tighten again. Now, interestingly, it wasn't they were starting to tighten, but they were pulling back from quantitative easing. The next low in gold was actually marked in December of 2015, which was the Fed's announcement that they were going to start raising rates again. And that marked an increase because the market didn't really believe that marked a beginning of a rally in gold because the market did not believe that the Fed could actually accomplish that.
The other scenario, one to hear, the other scenario is that we're not going to get a financial crisis in the next couple of years. There will be a soft landing. Everything will be fine. The Fed does not need to lower rates, and none of what we talked about is going to transpire. What probability, roughly, would you assign that scenario?
Again, I would nothing is impossible, and I would assign that an extremely low probability because the debt starts to compound on itself. The debt costs start to compound on itself. They will get unsustainable very quickly. You know, the only way to get out of this debt trap, the only few ways you could do it would be to cut spending. I mean,
Yeah.
that's
What do
laughable
you
on
think
its
they'll?
face.
Well, I was going to ask you about that. What do you think they're going to cut the government if they can't pay? Well, let's say not they can't, but if they want to move things around, they want to afford this $1 trillion interest bill. Do you think they'll cut on defense, Medicare, Social
No,
Security?
no. They can't. They've proven that they can or they won't. Either administration, either party, they can't cut spending. So that possibility, you have to laugh at the potential to do that. They could raise taxes, but not so much that they wouldn't kill the golden goose and kill off the economy. They can't raise taxes enough to close this debt. They could confiscate all of the wealth of all of the richest, the top 10% of all American citizens and not make a dent in it. So they can't really raise taxes enough to do it. Can they grow their way out of it? If there's some phenomenal technological productivity enhancement that would get them to 5 to 6, 7% GDP growth rates, maybe they could, but I don't see that happening in the near future. So if you can't cut, if you can't grow, if you can't raise taxes, the only thing you can do is depreciate the currency. And I don't, unlike many of my colleagues in this hard money industry, I don't think depreciating the currency is a strategy that governments undertake. They're kind of forced into it. Their backs against the wall, and they have to finance the debt. So the debt comes first because they can't resist doing that. And then they have to finance the debt, which in turn depreciates the currency.
Okay, very good. Tell us about the New Orleans investment conference. What can we expect this year that may or may not be different from prior years?
Well, this is our big 50th anniversary. The New Orleans Investment Conference is the longest running investment event in the world. And we have a long established tradition of bringing in the top level speakers in the world today, the best experts, the most insightful commentators on what's going on. And we're taking it to an even greater level this year. We've got Jim Grant coming. We've got Rick Rule coming. We've got Lynn Alden coming. We've got Jim Iorio, James Lavish, George Gammon, Dave Collum, Danielle DiMartino Booth, Brent Johnson. The list just goes on. And, I would encourage your viewers to go to neworleansconference.com to get a sense of who we are and what we do. But the one thing that you'll realize is that we bring together the best minds, not only on our stage, but in our audience. And it's an event that has to be experienced to really be appreciated and understood. And so we encourage people to come this year. We have a money back guarantee if you don't believe it was worth every cent. But once you come, you'll see why you need to come every year and really get the insights that you can't get at any other event.
That and the jazz. So that's another selling point of New Orleans.
Yes, absolutely.
and the croc. All right. Very good. So I look forward to that conference. Thank you very much. We'll put the links down below and to the Gold newsletter. So make sure to check out Brien Lundin's work. I appreciate your time today, Brien. We'll speak again soon.
David, it was wonderful talking with you. Thanks so much.
Thank you. And thank you for watching. Don't forget to like and subscribe.